Greetings, my name is Christopher Bell, Certified Public Accountant. In this video, we're going to cover some basic accounting concepts for inventory, buying inventory, and selling inventory. Now, if you like me, if you like the way I look, if you like these lessons, you can book a personalized one-on-one coaching session with me. There will be a pinned comment below. Let's dive right into it. So here's the scenario. This man right here is Christopher Bell, aka me. And he decides to start his own business. He wants to buy stuff and then sell it for a higher price. Hopefully that's what everybody wants to do when they have a business. And there's nothing more appealing to Christopher than buying books and then selling them for higher prices. Specifically, Chris focuses on a hot commodity from Financial Fortress, Zero to Wealthy at age 28, by the famous investor Jeremy Lefebvre. So what Chris is going to do is he's going to buy these books and then he's going to sell them for a higher price. So as we're going through the journal entries, imagine Chris buying these books and then reselling them. Let's dive right into it. So the first thing we have to do is buy inventory because we need to buy the book before we sell it, right? So on March 1st, 2023, Chris buys 1,000 of inventory, half with cash, half on credit. Let's do the journal entry. First thing you always put on there is the date. And trust me, I forget that too a lot. Put the date on there. It's very important. And then we have some debits and credits. What are we debiting? Well, we purchased inventory, which is an asset. And because we have an asset coming into our business, we have to debit the asset to increase it. So we debit inventory for $1,000. Now, we paid it half with cash, half on credit. When you see a problem that says on credit, we're dealing with accounts payable. So half of 1,000 is 500. So we have a credit to cash of 500. Why? Because cash is leaving our business. Cash is an asset. To decrease an asset, we have to credit it. What about credit? Well, accounts payable is a liability. To increase a liability, because now we owe money, we credit that liability for $500. And there we have our first journal entry. Inventory 1,000, cash 500, accounts payable 500. Moving on. On March 3rd, 2023, Chris settles his outstanding balance with the inventory vendor. So we bought inventory and we have a balance of $500. We owe them $500. Now we settled the balance. What does that mean? That means we paid it off. So we no longer owe money. Since we no longer owe this debt, what do we have to do to decrease the debt? We have to debit the debt. So we go ahead and we first put on the date, March 3rd, 2023. And then we debit the accounts payable for $500 because we paid it off. We decrease liabilities with a debit. And then we pay cash because we've settled it. We've paid off the debt for $500. So that's a credit to cash to decrease it. Now we're free and clear. We don't owe any more money to Financial Fortress. Now we're going to sell the inventory. On March 5th, 2023, Chris sells half of the inventory he purchased on March 1st, 2023 for $3,000 on credit. Now, when we do a sale of inventory, it's a two-part transaction. Always think of it as a two-part transaction. Part one is we record the sale. Part one, record the sale. Part two is we record the cost of goods sold. So you're going to have a sales transaction and a cost of goods sold transaction. And by doing that, it basically helps you not forget that there's actually 4 accounts that are in play here. A lot of people forget that, and they say, oh, I'll just debit this and credit that, and I'm done, and then you completely miss the inventory and the sales portion. So let's go ahead and record the sale. So so I'm the seller now. I'm making money. I'm generating revenue for my business. I sell half of the inventory for $3,000. Now, one quick note. When it comes to accounting, inventory first goes on the balance sheet as an asset, and it is only expensed through inventory expense, aka cost of goods sold, when you sell it. It's called the matching principle. Inventory will sit on that balance sheet as an asset until it is sold. Once it is sold, then it transforms, basically, a simple way of putting it, into cost of goods sold. That's the matching principle of accounting. So keep that in mind as you're doing this. So we sold half the inventory for $3,000 on credit. So for the sale transaction, first we put the date, March 5th, 2023. And then we debit what? Are we getting cash? No, it's on credit. So we actually have to debit this account called accounts receivable. Why? Because somebody owes us money. Now, we sold this inventory for $3,000. So whoever we sold it to owes us $3,000 in cash. They haven't paid us yet, but they better pay us. Our credit is to what? Well, we sold something. When you sell something, you're generating revenue. So we're going to credit revenue for $3,000. So far, so good. We have our debit and we have our credit, and that's the sale part of the journal entry. Now we have to do the cost of goods sold transaction because we sold the inventory, right? We have to take this inventory off of our books, or at least some of it, and record the cost, the expense of the inventory. So we record the date, and then we say, okay, how much did we sell? We sold half of the inventory we purchased on March 1st, 2023. What is that half? Well, we bought 1,000. What is 1,000 divided by 2? 500. So we're going to first debit inventory expense, aka cost of goods sold. Cost of goods sold, 500. And we credit what? We credit inventory because we sold the inventory. It's literally leaving our business. We gave the inventory to our client. They now have it. We don't have it, so we have to decrease that inventory by $500. So another trick question, well, not even a trick question, is what is our profit from this transaction? Well, we sold half the inventory for $3,000 of revenue, and the inventory cost us $500. 3,000 minus 500 is 2,500. That is our gross profit from this specific transaction. Now let's do the last entry for this problem, and then we'll close this out. On March 8th, the customer settles their $3,000 outstanding balance. Remember, we sold them the inventory and we said, hey, you can pay us later. So now they're paying us back, which they should, because I would not be happy if I didn't get my cash. So first, we're going to do what? We're going to credit the accounts payable. Of course, we have to put our date on there. First, we credit the accounts receivable, and then we debit what? Well, we're debiting cash because they're paying us cash. So we debit cash for $3,000. And now everything is honky-dory. Everything is good. We got our money. We sold our inventory, and we can continue our business. Hopefully that kind of cleared up some inventory transactions. Hopefully that makes sense. Like I said, if you want to book a private one-on-one session with me, more than willing to teach you accounting on a one-on-one basis over Google Meet. Hope you learned something. Have a wonderful day.